Now, as promised, there's the slide from the previous video once again. And again, all we're going to focus on here, again, here's the basic information, and here's the period that we're doing this for right here. All right, so look at the next slide. Again, it gets kind of busy here. Just bear with. Okay, so what you're looking at there is basically right down here. That's the that's going to be considered the payroll register for this business here. In other words, this is going to give the W-4 allowance, and again, in this case, allowance just means married or single. That tells you which table we're on, because up here we have a bi-weekly payroll period, and we have a table for single people and married people. All right, so we'll briefly go over some of the math that goes into what you're looking at here. I'm not going to belabor it, but just so you understand the concept of where some of the federal numbers came from, like how do we get that number that you're looking at there. All right, so again, the importance of year-to-date earnings is because this is going to, because we have a couple of ceilings to worry about here. We have to worry about the ceiling on Social Security, and also we have to worry about the ceiling on the unemployment insurance. Of course, that's only applicable to what? To employer payroll taxes. Again, employees do not pay unemployment insurance. This is a big point of contention. Cannot tell you how often people get that wrong. How many people labor under the illusion that they're paying into unemployment? You're not. This is true that your employment is stimulating your employer to pay in to unemployment. That's true. Your employment does stimulate your employer to do that, but you personally do not pay into it. Nobody does, except the employer themselves. All right, so we got this year-to-date column, which is just like it sounds. How much has each employee earned so far in the current year? And then we have, of course, our current earnings for the current pay period. Now, again, that's what we're going to have to worry about and observe potentially some ceilings here. All right, just checking something before I continue. I thought there was a mistake in something there. It's fine, again, with respect to the year in question. All right, so what do we got going on here? Okay, so we got current earnings. We have to add a column because of the ceiling on Social Security for Social Security earnings. In other words, is there anybody who's above that threshold in this pay period? And you'll see that these first 4 employees, no, because again, nobody's near the 128,700 ceiling. However, current earnings for Steve are 10,000. That puts him to 130 if we add it to year to date. But so therefore, because the ceiling is hit at 128.7, only $8,700 of that is applicable to Social Security from here on. In other words, this is the last time that Steve will pay into Social Security for the rest of the year. That's it. His Social Security earnings have topped out. He's done. All right, now the big column here is determining federal income taxes that need to be withheld. And remember, there's no withholdings here anymore, so again, it's going to depend on what table we are and where the earnings for this period are. Again, this is for bi-weekly, meaning we're paying every 2 weeks payroll, so right there, just to uncover that so it's clear. All right, so you'll notice these 2 employees, Dave and Jenny, have the same withholding because they have the same earnings, and they're earning the same in each pay period. So where would they? They'd be in the married, because they're both married, so they're in this set of tables over here. All right, so we're going to look at their earnings were right in this threshold here. In other words, they were over $1,177, but not over this number here. So it's 2,000. So they're right somewhere in the middle there. So the calculation for their withholding is going to be this base amount here. In other words, they've already figured it out for you. In other words, that the tax on $1,177 would be $73.30 worth of taxes. So that's already been calculated. So we're going to take that number, and everything above that 1,177 will be taxed at a 12% rate. All right, so there's the calculation done, so I didn't belabor it by making you watch me do all that. So 823 is the number, is the amount above 1177. So 2,000 minus 1177 will give you this 823. Make that look like 3 times 12% would give you $98.76 plus the $73.30 that we have right here equals our $172.06 for both of those employees. Right, so a similar calculation would go into effect for Mike and Mindy. Again, their wages are varying depending on hours worked, so that's why they don't have the same amount of federal taxes withheld. So where are they? Okay, so they made $996 and $1,086 respectively. So again, we're going to be in the single table over here. So they're both going to fall into this threshold. So again, over $509, but they're not over $1,631. So the base amount we're going to have here is $36.76, and then everything above that, $509 here, will be taxed at a 12% rate. So in the case of, we'll just focus on one of them. So in the case of Mike, all right, and there's the tax on the $478 above that 509, so $58.44 at 12%, plus the $36.70 is going to give us the $95.14. Similar calculation would be true for Mindy, except it would be $10.86 minus 509 at 12%, and then add the same $36.70. And in her case, we'd get 109 or 105.94. So that's where those calculations came from. And in the case of Steve, again, look at because he's making, again, federal taxes is going to be on the $10,000, not the $8,700. That's only for Social Security. So it's going to be $10,000. So again, he's going to be on the merit table here. So his base will be the first. So in other words, we're going to take $1,082.76 and add that to everything he made above $10,000. So in this case, that's going to be another $3,210 will be taxed at a 24% rate. Plus that $1,083.76 is where we're getting this amount here. So that's why the tax on that is going to be $1,854.16 for the current period. Right, so that's probably the most complicated thing to figure in what I'm giving you here. Again, this is where your software would come into play, and all these numbers we're looking at would already be loaded in there. So when you just put in the $10,000 for Steve, or the $996 for Mike, the $1086 for Mindy, or the $2,000 for either Dave or Jenny, boom, it would automatically give you what the federal withholding is based upon your pay periods are and the fact that they're married versus single. So all that would figure itself out. So that's again the beauty of that software. Now for the Social Security taxes, that's going to be referenced on whatever this column here says. So it's going to be 6.2% of 2,000. So that's why you'll see Dave and Jenny have the same 124 right there. And 6.2% of the 996 for Mike, the 1086 for Mindy will yield these numbers here, and then 6.2% of the 8700 for Steve will yield 539.40. And again, that's the last time we'll see that column used for Steve for the rest of this year. So in other words, for the next pay period, when it says $10,000 for current earnings, Social Security earnings will be set to what? Nothing. There'll be a zero there now. Now the Medicare column is going to be all your current earnings. So 1.45% of that. So all of those are consistent with 1.45% of either the 2000s that we see here, the 996 at 145, 1086 at 145, and then of course 1.45% of 10,000 will give you exactly $145 there. Now all the numbers you're looking at here are just numbers I just kind of made up based upon whatever. Don't worry about them. There may be some formulas underlying them, but you know it's not something you have to remember here, or something that's really, it's going to be universally applicable. I just came up with this for extra texture. Right, so all of what you're looking at from these columns, I'm going to clean this up a little bit. Hold on a moment. Right, so everything that we deducted in all these columns here for any one employee, right, all that's going to be added together and subtracted from the current earnings. So if you want to know what's happening in this net column, it would be Dave's $2,000 current minus what we calculated for his federal, his Social Security taxes, his Medicare, health insurance, United Way, and 401k deductions. So all those amounts added up and subtract from 2,000 will get you this number there, $1,367.25. Same is true for every single one of these employees. It's going to be current earnings minus those 1, 2, 3, 4, 5, 6 columns. Whatever's in those columns, for each of them individually, are added together, and that equals their net. Now, in terms of putting together the journal entry, right, because that's ultimately what this is leading us toward, the way you're going to address it this way is, okay, so whatever is in this total here for total earnings, that is going to be equal to your wages and salaries expense. So $16,082, or 100, 16,000, yeah, $16,082. I got it right. Is the current amount of your wages and salaries expense for the period. Now again, this column for purposes of that journal entry is meaningless. All these other column totals here are meaningful. In other words, everything that we have for those 6 deduction columns, those are all going to be set up as payables. Actually, it's going to be a series of 7 payables, because we're going to treat, again, this as like a salaries and wages payable, for example. It was a temporary holder until we actually cut the checks, and then we'll get that payable off the books. So each one of these amounts you're looking at here will be reflected on the next slide. So federal taxes payable is equal to that $2,399.36 that we had totaled here. And Social Security taxes, again, that'll be $916.48. That'll be credited to Social Security payable. Medicare $233.19. And then we have our health insurance contributions, $538.46. United Way contributions, $261.54. Oops, getting ahead of myself there. Right there. And then we have 401k contributions, $1,115.39. And then, of course, lastly, we have, as I said, it's a placeholder to this net payable here, $10,617.58 will be credited to salaries payable, or alternately, it could be directly credited to cash. But I just show it up. I just showed it like how a lot of businesses have it. They show up as a temporary payable. They pay it immediately, so that's why you see a second transaction paying that off, and then a credit to cash for a like amount. So that's the way to look at this payroll register, is it's a source document for this giant journal entry you got going on right here. Again, I think everyone will understand the need for payroll tax software in order to be able to tackle this. Otherwise, this is just completely unwieldy and possible to do on your own. Right now, last thing in this video is going to talk about employer payroll taxes. Now remember, employer payroll taxes are dealing with, specifically, like the only thing that applies to them that doesn't apply to employees is unemployment taxes, and then matching Social Security and Medicare. So in the example we just looked at, because everyone had earned more than $7,000 for the year, payroll tax expense was limited to just matching Social Security and Medicare. So that's all you're going to see here. In other words, here was Social Security, here's Medicare. So payroll taxes for YYZ would be limited to just the matching those two numbers there, added together, excuse me, and that's going to equal your payroll tax expense for June 29th, 2018. That's it. So it's simple. So what I did to sort of like reinforce this ceiling idea here, the $7,000 ceiling on unemployment, is I went back to the 4th pay period of the year to show what's going to happen in that time frame there. At this point, we only had paid out, so it was a 3 pay period, so it was $6,000 each to Dave and Jenny. Total wages to Mike and Mindy was, again, this varies, so that's why those numbers vary, $3,096 and $3,420. And Steve's first 3 payrolls were each $10,000. So we have current earnings, same as we had before, because $2,000, $2,000, $976, $1,032, and $10,000. Again, the numbers here are just sort of made up for those employees. Now we have a column for something called unemployment, earnings in this case. So in this case, unemployment earnings is only going to be for Dave and Jenny an additional $1,000, because remember, the ceiling hits at $7,000. Again, that's the universal rule that applies to all states. Minimally, states can have higher ones, as I demonstrated for Illinois, but we're just going to stick to this idea for now. So that means that we only have to collect unemployment on the $1,000 they made above that. For Mike and Mindy, again, they haven't hit that threshold yet. And of course, what happened is Steve hits that threshold in when? The first payroll. Right, the first payroll year, he was paid $10,000. The first $7,000 was applicable, and we were done collecting unemployment on behalf of Steve for the rest of the year. Right, so for purposes of this entry, again, we're just focusing on the payroll taxes expense for the employer here. So it would be 1.6 federal, 5.4 state, and again, it's going to be those percentages applied to this column here. So that's why it's going to be only 0.6% or $6. I mean, these are minuscule amounts of the $1,000 for Dave and Jenny. For the federal, the state, we're going to collect $54 each because it's 5.4. For Mike, we're only going to collect $5.87 of that $978 for the federal. $52.87 for the state, and then for Mindy's $1,032, federal government will get $6.19. The state government will get $55.73 on her. Right, so the important numbers for this one, and I also calculated the Social Security and Medicare, and again, there's no ceilings on those, so those are both going to be calculated on current earnings for the period. So just 6.2% of 2,000 for each of them, same as we had before. 6.2% of the 978 and the 1032 will yield these numbers, and then 6.2% of 10,000 will give us 620 for Steve. And Medicare is going to be 1.45 of all the numbers you see in the current earnings column. So $29 each for Dave and Jenny, $14.18, $14.96 for Mike and Mindy, and then finally Steve will be another $145. Got a little out of hand there for a moment. All right, so these are the totals we're interested in for this entry here. That you'll see here. So that's the amount that we're going to put to federal unemployment payable. That's the amount we're going to put to state unemployment payable. This is the matching Social Security that we're going to book, and the matching Medicare. So I'll add those four numbers together here, and that will equal the total amount we're going to debit to payroll tax expense for YYZ for this period. So that's where we get $1,465.36. So to reiterate, unemployment is only the responsibility of the employer. Employees do not pay anything into that directly out of their own pocket. All right, that concludes the payroll tax material as it pertains to this 7th chapter in the class. So next up, look for the concept of dealing with sales taxes. So see you there.